Testing, testing, 1, 2. Alright, the webinar shall begin.
Hi everyone, thanks for tuning in. Today we'll talk about two things primarily. First, we'll give an update on the earnings season. Second, we'll talk about, we'll also elaborate more on Heng heavy machinery. So, on the earnings update, the usual disclaimers. On the earnings update, you can see over here the this chart actually shows you the changes to our forecast for both revenue and NPAT. Generally, there's quite a bit of downward revision. However, we just focus on the ones that are more of bigger quantum. So in terms of sector costs, there are no changes to our sector costs. But today, I'd like to highlight to you three companies. The first is Bosted. Right, you can see over here that Bosted, there's actually been a 17% increase in our forecast for net profit after tax. And a -3. The -3 is because of some deferred revenue in which we see that the net profit will be recognized in the next year instead. Right. But that said, we continue to believe that this counter is a very strong one. For StarHub, there's actually also been an increase in the net profit after tax of 8% for this year and 14% for next year. Genting, we also saw a very huge increase in the NPAT adjustment. However, we remain neutral on Genting, and we will explain to you why. So, on Bosted, this is the price chart for Bosted. It's currently trading at approximately 154. So even though the first half wasn't a great year, however, we see many catalysts ahead of us. First, currently order books are at a record high, and this is expected to drive better earnings next year. Also, 60,000 square meters of industrial portfolio space is being developed, will boost recurring income. This is once again from the design, build, and lease segment of Bosted. 120,000 square meter of industrial land is also available through its 35% joint venture in Iskandar, Malaysia. So you can see over here that there's lots of firepower to ramp things up further, and also Bosted continues to generate high free cash flow and is currently in a large net cash position. And we believe that it's deeply undervalued with clear catalysts ahead. Moving on to elaborate, you can see over here that the record order book is especially slow in the real estate design and build. Right, right now it's at 245. This is including a big contract which was recently won by Bosted. And for the design, build, and lease segment, we see that this 60 square meter of industrial portfolio could bring profit before tax contributions from 15.3 to 26.8. Right, and you can see that this over here, that in FY16, portfolio is expected to be in 160,000 square meter. And 160,000 square meters is actually a good size. And moving forward, with further increase in this industrial portfolio, we see opportunity for Bosted to be able to realize the value of this through a REIT, right? So for Iskandar, Malaysia, which is the 35% joint venture that it has, this is in a prime limited part of Iskandar, Malaysia, and we believe that the interest will be huge, and that MNCs would want to rent a space in this due to its good geographical location. Also, Malaysia has no formal plot ratio, and this could lead to creative development in this area. So once again, why it is still deeply undervalued? The net cash position is actually currently at 120 million, and we continue to expect high free cash flow generation. Right. Once again, also with more industrial property deals and developments, this could lead to an opportunity to REIT. So once again, the number of projects right now that it has is 160, which is 71% of that needed to form a REIT. So on why it's deeply undervalued, market cap is currently at 783 million based on last price. If we were to less off the forecasted cash of 225 million and also the property valuation of 238 million, this actually leaves us with a good value that leaves us with a value of 320 million for the rest of the segments, including the energy engineering, the design and build, and geospatial technology. This is just 5.5% of PE, and from an EV/EBIT perspective, the group is trading at 6.5%, 6.5 times. Once again, the listing of the industrial portfolio would be a way that Boston can potentially unlock the value. So this is once again the overview of the stock. We value Boston with a buy at $1.52. Target currently it's $1.52 and target price is $2.05. For StarHub, we also saw an increase in the year-on-year forecast. The reasons for higher forecast is due to a few reasons, including higher postpaid net adds that we saw for StarHub relative to the other two telcos. Also, we expect to see better margins from low cost of sales, and this is also with the lower subsidy that the telcos are going to give for subscribers. We also see higher adoption grant income on NGN BM takeout. This is through the higher number of fiber broadband customers. Other investment merits for StarHub includes an attractive dividend yield of 4.6%, and we continue to see good traction from data monetizing, and this will lead to higher mobile revenue. So you can see that the telcos continue to report higher number of LTE adoption, and also we continue to see a good proportion of these people exceeding their data allowance, and this has actually led to better monetizing of data. We continue to maintain accumulate for StarHub with a target price of $4.52. On Genting, once again, we remain neutral. This quarter, we saw a higher VIP volume, and that actually was the main thing that led to the higher forecast. Management continues to be confident of the traction that we see in the higher VIP volume. This is actually a segment that earns approximately 3%. Basically, the amount of money that's put on table typically we earn 3%. The one that's higher, more attractive is the mass market. That one in that segment we actually see approximately earnings of approximately 20% of the money that's gambled. For the mass segment, unfortunately, we do not see much increase in volumes, and increase in mass market volumes would also be a potential catalyst for the stock. Also, we also revised our forecast higher due to better margins from cost rationalization. This includes cutting down staff expenses with a lower number of staff hired. We also saw a higher number of visitors for the Universal Studios and also for the Marine Life Park this quarter. This quarter, there was also a higher net one-offs gain, and that led to further increase in our forecast for this year. Other investment merits which we think a potential re-rating catalyst for the stock includes an entry into Japan. The overall guidance in terms of Japan is that in approximately between Jan to April, the Japan could potentially legalize gaming, and then from there they will start to bid for which cities to hold a casino in, likely this will be Tokyo and Osaka. After that, then they will start to bid for which casino operators to be able to operate in Japan. All in all, this will take a couple of years, including building time. Another investment merit potentially would be that Genting has guided that they are likely to participate in another Asian leisure. So depending on what they participate in, this could potentially be a catalyst should we see good synergies and also good profit making ability from this Asian leisure. On investment actions, once again, we think that more visibility is needed. First, we need to see whether or not they are able to to be able to build a casino in Japan. Second, on what kind of Asian leisure they're going to build. And third, on what volumes, mass market volumes they are going to be, and whether or not the VIP volumes can continue to grow, right? Because therefore we may have a neutral rating with a target price of $1.49. Now moving on to Heng.
Hi, good morning everyone. Here's an update on Heng Heavy Machinery. Hi. Yes, here's the update for Heng Machinery. Okay, essentially we're going to go through, we think that the tagline is slow and steady towards new frontiers. We're going to go through the formalities and business model, the quarterly update, and valuations, which we still think is attractive, 26.5 cents, which represents roughly a 26% upside from today's price of 21 cents. Okay, so just a quick breakdown for Heng. We like Heng because of these reasons. There's growth in favorable regions. Asia GDP is expected to have 7% GDP growth and more than 5% construction spending growth till 2018. Trading and rental revenues to improve moderately this year and more so in FY15. There's also a good margin of safety for patient investors because for Heng, 83% of their PPE are actually cranes, and this means that 93% of their assets are actually monetizable. Considering it's trading at a PV of 1, it means most of your equity is actually monetizable, which gives you a good margin of safety. This year, there's increased breadth and depth. We see upside with expanded product offering. Late half of last year, they have increased their product offering to include mighty cranes, which are basically mini crawlers. So now they're essentially having a better product offering compared to the regular and mid-sized crawler cranes. And also, they've also set up after sales support site in Indonesia, and this will basically help to drive sales in Indonesia. Okay, they also capitalized for expansion. And as we know, they just raised $17.9 million rights issue last year, and so they are ready for expansion. And also, there's potential upside risks if TTC can secure mega project bids in Southeast Asia. As you know, they have a construction arm and they are active in bidding for construction projects in Asia. And there's upside risk if they do indeed secure any of these mega project bids. Heng will benefit. So we're expecting a low to mid single digit net income growth for FY14 and 10 to 15% net income growth FY15. Okay, target price is 26.5 cents based on residual income valuation, which corresponds to a EV over EBITDA of 4.83, which so happens to be the pure average. So this is not a demanding target price. Okay, just to recap, Heng has a rental and trading segment. Okay, and we say they're synergistic. Okay, in the sense that they have a rental fleet, but at the same time they trade in Asian regions, and because of this they can maintain a younger fleet because of efficient trading. Okay, we'll go into details here. Okay, so here you can see their global network. They have physical subsidiaries in Myanmar, Vietnam, Malaysia, Singapore, and Indonesia, as seen by these diamonds over here. But their trading networks span actually Southeast Asia and globally. Okay, here the typical types of cranes that they offer, and these are the new mighty crawler cranes and aerial lifts. Okay, so to recap, one of the synergistic advantages that they have is they efficiently maintain a younger rental fleet. Okay, of less than 5 years old. They do that by efficiently renewing it based on the new cranes that they receive from Cobalco, Kato, and Mighty Crane. They have dealerships and distributorships for these cranes here. Okay, they can sell new and used cranes into third world regions to maximize their profitability. Okay, at the same time, and by the way, since 2011, right, they have increased their trading revenues by 80% and rental revenues by 60%. Margins are relatively stable since then. They are also partnered with Toyota Tsusho Group, which can provide opportunities to them. Okay, Toyota actually owns 27% of Heng and are active in operations. Okay, so we talked about these are the strengths of Heng, and and going forward. So let me just recap. They have a competitive business model, synergistic rental and trading arm. They have actually been in the business for 40 years, which is very long. Okay, they are endorsed by Toyota Tsusho, which has a 27% stake, and is a major dealer and distributor of Kelbalco, Kato, and Mighty cranes. Okay, and they are one of the leading crane traders by revenue in Asia itself. Okay, so we mentioned these things going forward. So let's just do the investment merits. So once again, yes, we do think there's net income growth of low single digit in FY14 and 10-15% in FY15. Okay, the low single digit growth is because of the incubation period as they are setting up in to expand regionally, basically. Okay, trading and rental revenues are expected to grow. Okay, this is a big function of the fact that they're in Southeast Asia. They've set up physical spaces in Southeast Asia, and in Southeast Asia, there's a projected 5% plus of infrastructure spending till 2018. Okay, so cranes are movable and monetizable. PV of 1. So here's a target price of 26.5 cents. Okay, quarterly update. Essentially, the rental revenues, right, have declined year on year, minor decline, but this was expected already because of project completion and minor delays in the domestic market, i.e. Singapore. But trading revenues and gross profits more than made up this rental decline, okay, because on the back of increased regional demand, as we mentioned before. So the net impact essentially is that net income increased by 14.6%, which is in line with expectation, and this increases the probability of attaining our conservative mid-single digit growth in FY14. Okay, forecasts. Okay, so as you can see on the bottom left here, this is the net profit forecast. As you can see, net profits to grow low single digits FY14 due to slight margin decrease due to wage inflation and setup costs and certain project delays. But that's only for FY14. This is expected to improve in FY15 to grow roughly 10-15% because improvement of margin and increased number of regional project biddings in accordance to the expansion base in FY14. Okay, so we expect rental and trading to essentially be improving year on year. This is just a summary slide to shows you the rental and trading revenues. Here you can see that that they have been consistently increasing their PPE, which is mainly comprised of cranes, as well as their book value. As you can see, essentially they have a plan to increase. They have been increasing since 2009, and they plan to increase it by the same organic rate, which is highly probable. By regions, we just like to note that Singapore still takes up 50% of the revenues. Okay, but of course, as the time goes by, we expect these segments, the Malaysia, Vietnam, Brunei, Myanmar segments, to take up more of the pie going forward. So just note, Singapore is a stable market base. Okay, and the rest have higher growth rates, and as we will see later on. Okay, just to show you some regional analysis, right? Paced by China, many Asian nations continue to make infrastructure development a high priority, building out on some of the most advanced integrated systems in the world. Okay, so here you can see that in 2005, this was the percentage of construction spending worldwide. Okay, Asia took up only 31%, but it is projected by 2020 that it will take up 46%. The Western continents will be declining, and Asia will be ramping up. And that's why Heng is positioned very well. In terms of dollars, you can see the billions of dollars being spent here on construction. And these are the projected growth rates. Okay, as you can see, Singapore is stable with a 3.5% growth rate. Note that it's not a negative growth rate. And Malaysia, Vietnam, and Indonesia all have growth rates which are basically from 4 to 7. So this bodes well for the regions that Heng is currently planning to expand in. Okay, here's just a survey of projects available in Singapore itself. Okay, I won't read through all of them, but essentially you can see from now till 2027, even you have at least about $100 billion of construction going on. Okay, so Singapore has a stable base of projects going on. Now, for the rest of the regions, for last year, this is the construction spending, 17.6 billion for Malaysia, etc., etc., and this is expected to grow as well, on an average of 5% a year. So this also bodes well for Sin Heng's, especially their trading arm. Okay, so valuations using residual income valuation, just using an overall cost of equity of 9%, we come up with a target price of 0.26.5, and this also corresponds to the enterprise value over EBITDA of 4.85, which is very reasonable, and this happens to be the peer average as well. Okay, this is the summary slide of Sin Heng, as you mentioned before. Okay, and that is it for Sin Heng. Okay. Please hold on for a second. We're having a technical glitch. Okay, please hold on. Are there any questions for these companies first? Hold on, please. I'm missing on market slides. I'm not sure why. I don't have it.
Hi, there's a question on the duration for target price for Bausted. The duration on the target price is a 1 year target price. Yeah, it's not a 3 months or 6 months. It's typically on a 1 year. It's on 1 year horizon. It's gone for a while. We're actually trying to upload some slides with regards to the market.
Can you cancel the screen first? Okay, sorry. Before we go into questioning, I just want to quickly go through some of the technicals for the market first, which we just didn't have just now. Okay, just very quickly, on the S&P itself, what has happened is we have this grind upwards in price, and so I mentioned before that we need to see whether the price can actually be elevated off this resistance level of the descending triangle, and it has. Okay, so not only has it gone up, right, there is actually some support with the breadth indicator. The McClellan oscillator has finally crossed into positive territory. So it just shows me that this move has some conviction to it. It is not fantastically strong because of decreasing Russell over S&P ratio, but at least you have breadth support. Okay, so technically how you see this is that you have to assume it's an uptrend unless the price actually comes down and breaks back into this ascending triangle. Okay, so we can use this ascending triangle as your support line, and as long as you can keep above that, we expect it to grind higher slowly, essentially. Okay. Okay. Now for China, more interestingly, we note that late last Friday, the FXI, which is the US China ETF, rallied pretty big on the US market. Now why? Let's just go there quickly. So this is the FXI, which is the China ETF. You notice that there was a gap up in price, and that was because late Friday, China leadership pledges expansion of economic freedoms. They basically released their document which covers 60 different measures, okay, of how to improve or encourage economic freedom in China. So this is their major economic reform policy, and some of the things that they are considering includes accelerating convertibility of the yuan and freeing up interest rates to improve treasury yield curves and let private investors set up small medium bank size banks according to the decision. But this is just, it includes many much more. And so this was received positively by the US market. So as you can see, a gap up on heavy volume. Now, what does that mean for us? Not very interesting. Now, we've been mentioning for weeks now that we suspected that this is a bottom, that this is a dull bottom in the China market. But at the same time, we also recognize that technically, I mean, that's why we do technicals, technically we have not been able to break through this downtrend support. So now we need to basically see if there's enough stimulus or is enough excitement in the market to actually break through this downtrend. So traders would probably be served well to see whether the price breaks the downtrend, because if it does break, it could signal that this could be a bottom, or at the very least you have a short-term up move up to 20, at least 2400 at least. Okay, so once again, technically, now that there is some excitement in the China market, see whether it can break through this downtrend line. Okay, for Singapore, same thing. This is our proposed pattern based on probability, and essentially, as long as the price can keep above this support line of 3150, we do suspect there will be that the bias is upwards instead of downwards. But of course, we do need to cross this resistance line over here that's just below 3300. Okay, so that's it for the Singapore market. Okay, thanks. Now we shall open the time up for questions. Okay, here's a question. The question is Dongwon and Heng in the same trade? And the answer is yes. They both, they're the same but different. I mean, Dongwon also trades Dongwon rents cranes, and so does Heng. But at the same time, they have a very different model. Dongwon essentially rents cranes, and they have a very, very small trading arm. In fact, they don't really trade. Whereas Heng is a designated trader and renter. They have extensive trading networks. Heng actually has the biggest trading by revenue in Asia as compared to all of the Singapore competitors, Dongwon, Tat Hong, and Hiap Tiong. Yeah. At the same time, Dongwon also has a tendency of using China cranes, whereas Singapore, whereas Heng is actually they carry Japanese cranes because they brand themselves differently. Japanese cranes have are known to be more reliable, have better after-sales service, and they have much more resale value than China cranes. So they have a slightly different business model. Okay, another question. Heng's executive compensation is very high. This is not a concern. Interestingly enough, this concern was raised by a couple of shareholders by the EGM, and from what I understand, they are looking into it. Executive compensation, look into it. But we also note that the executive compensation is actually very much performance based. And last year they severely outperformed. They really outperformed. They more than doubled their net income, and that's the reason why the bonuses were so high. So we expect that this type of bonus will not be so excessive this coming year. Next question. How much debt does Heng has compared to cash? Note that Heng as of right now is actually net cash, and their competitors are roughly 50% debt to equity, which is why Heng is a much more compelling investment in my opinion at this point. Heng has a PE of 8 right now, which is essentially just slightly lower than the peer average, but the difference is that they are able to generate a PE of 8 while having essentially no debt, but the rest are already levered up. What is the yield for Heng? They don't have a specific dividend policy because they are a growing company, so they have and they are very opportunistic in their growth. So sometimes they will not be able to predict how much money they will need for expansion. But typically, they do give out roughly a 4% dividend yield.
Hi, there's a question on the yield for Boston. Dividend yield wise, we expect it to be in a range of plus 4 to 5%. That's for dividend yield. This is supported by the high order books that they currently have, and also sizable recurring income. The recurring income would come from two areas. The first would be from the industrial design, build and lease. The second would be from the geospatial technology, in which management has guided for 30 to 40% of that to be recurring. Okay. Okay. This is a question on analyst projects equities to be up in the next 2 weeks. What is Philip's view, and if up, will penny stock be in play again? In terms of penny stock, seasonally this quarter is one in which trading activities are typically weaker. Since the 3 penny stocks previously, market confidence has been affected. Whether or not penny stocks will be in play, seasonal trends are against it, and so is the market confidence. But that said, we continue to be positive on the trend of the STI being upwards, as touched on just.
Okay. With the current market, is it a good time for entry? Well, this is a market question again. So this is how we view it. Okay. I mean, there are some jitters in the market. Let me go to the market slide. Okay. There are some jitters in the market right now. STI market, sorry, here we go. Some jitters. As you can see, we're not having such an aggressive up move as what was expected. Okay, neither is it collapsing as well. However, so basically, we look at the macroeconomic mood right now, and you have some good things going on. You have a little bit less uncertainty now that the new Fed chairman, okay, Janet Yellen, right, she turns out to be more dovish than expected. She's more dovish than expected, and now you have this potential sentiment change in China because of the massive reforms that they're trying to make, right? So because of these two things, I mean, there is some reason to believe that stocks can actually drift higher for the next 2 months, okay? But at the same time, technically, right, to account for this uncertainty and this market risk, what you can do is you can simply just draw a line of support here at 3150. You can, if price actually breaks below 3150, right, that will then we should be cautious and maybe change our thesis that the market knows something that we don't. But at this moment, if it doesn't break 3150, based on the potential change of sentiment in the US and China market, we believe there is enough reason for the price to go up.
There's a question on where you can get materials for the webinar. Once again, to get the materials for the webinar, you can actually go to this website called UniPhillip, UNIPHILLIP.com, and from there, you can actually access. You go to education materials, and there'll be a Philip research webinar. From there, you can actually access the old webinars and also the materials for this webinar. Furthermore, for today's webinar, we would be sending out the materials. Oh, sorry, we have already sent out the materials.
Okay, we have a question on Bowstead. Is Bowstead a good entry for now, given the market sentiment is jittery at the moment? Okay, the thing about Bowstead is I think in general the market has reasons to go up. Okay, and so there is potential, but so two things I would say. One, look at the Bowstead chart. Two, look at the SCI chart. Okay, so there's some correlation between the two. Now, in Bowstead's chart, right, you have to see if price can penetrate its all-time high. If price can penetrate its all-time high, which is 1.54, and we note that there are fundamental reasons to do so, then yes, you should. I will say if the price breaks through here, you should get in. Okay, you definitely should get in, especially if the STI looks as though it is not going to break down anytime soon. So as long as either if price breaks through 154 on the Bowstead chart and the STI is not collapsing, then I think it's a good trade to make. Yes, we will be resending. Oh, the question is, can you resend the webinar materials? The first one did not have the market, and yes, we will resend the new one.
There's a question with regards to the oil and gas market. Currently, we are still bullish on the oil and gas sector, given the stable oil prices, which is hovering above $100 per barrel, as well as the long-term contract that is actually secured over in the US side. We see drillers securing long-term contracts, drillers like Transocean, Seadrills, etc. So we remain positive on the ONG segment, and we still see further upside in terms of our the counters that we recommend. This includes Capital as well as Ezion Holdings. Our target price for Capital is 1207, which implies potential upside of slightly more than 10%, including dividend yield. Similarly, for Ezion Holdings, we issued a report today. Our new target price for Ezion is 253 after adjusting for the after adjusting for the bonus share issue. So we still see upside for these two counters that we highly recommend over in the oil and gas segment. Thank you.
Hi. There's a question on our outlook with regards to Suntec recent acquisition. They actually purchased a potential property that's only coming on board in 2016. Currently, based on their purchase price and also our estimates, the yields for that side will be between 6 to 6% for the commercial, even at relatively good price. It will only range between 5 to 6%. So is it yield accretive? Currently right now it's kind of just in line with what their current assets are actually doing. I think that the upside that is actually within the horizons actually their completion of the current renovation at their Suntec, the retail site, and also the convention hall that it has also seen quite evident upgrades. So these two actually still be the reason that's driving the stock forward. It is in this sense, it is a good REIT to be looking at, and should at current yield levels is still there will still be some downside to the REIT price. So when it actually dips, it will actually there may be a entry point then, but at current levels is not. All right.
Hi, there's also another question with regards to the shipping industry. Currently, we are positive in terms of the offshore and marine outlook. In terms of shipping industrial counters, investors have to be selective in terms of selecting the counters that you want to invest in. Currently for Yangzijiang, we see that execution risk for Yangzijiang remains relatively low as compared to Costco, given the fact that their portfolio, their order book is still exposed mainly to their core business, which is shipbuilding. As for Costco, their exposure over in the offshore segment gives them a higher execution risk. Recently, they have also encountered problems in terms of meeting the contracts for their drill ship projects, which they have already delayed for more than 1 year, and the customer actually cancelled the contract. That actually causes them to incur losses. So in terms of the shipping segment in general, investors have to be selective. Select companies that have a strong order book, not just strong order book, but also you have to assess the exposure of their order books. Currently, if you guys still want to go into the shipping industry, we recommend Yangzijiang over Costco. Thank you very much.
Okay, for question, UETF China S50, is it a good entry point at this point in time? And also, what about the STI index? Okay, let me just reiterate what the proposed strategy is. Okay, there are market rumors. There are the mood of the sentiment of the China market seems to have changed with the China's document, which they just released recently regarding economic freedom, right? But the thing is, we recognize that there is excitement in the market because of the U.S. China ETF. And the China ETF in the U.S. has spiked up, gapped up on high volume. Okay. However, now looking at the Shanghai index here, we do recognize that it is still in a downtrend. And I know that today it is positive. So what you would do is that to confirm a real change in trend, you would still want to see price break through this downtrend convincingly. If the China market can do that, then that will be a good time for entry. Right now, if you enter, I mean, it really depends on your risk tolerance because it is not confirmed that you can break through yet. Okay. However, we feel that this could potentially be a bottom, but this bottom will only be confirmed when the price can break through this downtrend, and we are starting to see signs that it just might. That is for China. For Singapore, we believe that it is possible for the price to grind upwards. So what we can do as a strategy is that as long as the price doesn't break this support level of 3150, we are assuming a bullish stance until this support is broken.
There's also a few questions on NOL, HPH Trust, and Nova. Unfortunately, we do not have any coverage on these companies right now.
Question on what is the Shanghai component break-up point to watch out for? Let me just reiterate. This blue line here is the downtrend line. So you want to see the price break up through the downtrend line. At this point, the downtrend line looks like it's about 2,200. But of course, the longer the price moves forward, the downtrend line will actually continue to fall. So we have to monitor, on a weekly basis to see when it actually breaks up through the downtrend line.
There's a question with regards to the commodity sector. Currently, the counters under our coverage includes Wilma and Golden Agri. For Wilma, we remain positive on the long-term view of Wilma, given the fact that we see Wilma as a proxy to the Asian growing food demand. So in terms of the long-term fundamental, definitely remains sound and robust. Our target price for Wilma is 388. As for Golden Agri, after visiting the management, after the 3Q results, we still see risk over at the China operation, given the fact that China operations swing back to losses of about $2 million in 3Q. So the operation over in China still remains unstable in our view. However, if let's say investors are positive on the CPO outlook, Golden Agri is definitely a good proxy, as more than 95% of the earnings comes from the upstream business over at the CPO plantations. So our target price for Golden Agri is at 50 cents, and our recommendation for Golden Agri is neutral. Thank you.
We have a question on what about commodity sector forecasts. Okay. Okay, I just want to make it clear. Okay, 2 weeks ago, we actually had said that for industrial commodities means we're using the GSCI as a benchmark, which is roughly 60% energy, 10% livestock, etc., 10% industrial metals. For that benchmark, right, essentially there's a resumption in the downtrend. We believe in this cycle, eventually it will go up. But technically speaking, we are still on a downtrend. We are challenging the line each time, but we haven't broken up yet. So right now, we are temporarily bearish, and we're just waiting for the time that it actually breaks up.
Hi, there's a question on COTS. We actually downgraded COTS from buy to all the way to hold during the result season last quarter. And we have also removed it off our deep value playlist. The reason is because based on last quarter's results, we see some concern in the business in Malaysia. For Singapore, we continue to see positives in the business due to recent factors such as population growth, new housing coming on board. However, for Malaysia, this quarter they actually indicated that they continue to tighten credit. In fact, credit sales, like for like credit sales, have actually dropped 16% year on year. We think that this is a very huge is a very huge adverse factor for courts. Potentially, they may be over concerned with regards to credit, and this lower amount of credit, lower volume for credit sales have actually impacted the balance sheet, the P&L quite a bit. Also, we see that the megastore, the new KL megastore, has not really achieved sales volume that it should be. Being approximately, based on our estimates, is approximately 35% lower on cash sales. On sales per square feet, and we think that that's also a negative. So we continue to observe how the credit sales for Malaysia go, and based on more visibility in a couple of quarters, we would revise our call on courts once again. Okay, there's a question on the impact of Belsted if it rates its industrial assets. If Belsted were to rate its industrial asset, we believe that this would realize the value of its industrial assets. We expect that the value of the industrial assets will go up, and that would potentially give the opportunity for Belsted, among others, to give a special dividend yield.
Allow me to add on to what Ken just said. Boston is currently at about 8 odd percent in terms of their valuation and whatnot. If they were to read their assets at current market valuation of cap rate anywhere between 4.55 to about 6%, even to be conservative, they actually realize quite a fair bit of their value, and it will actually be bought well for them. So the question is whether they actually need this cash influx, and whether they do need this war chest. There are more potentially more yield accretive or value accretive business that they have. So having said that, if they were to read their business, it would be good. If not, then we are currently still doing well. The company is still, in our valuation, still conservative, and there's actually quite a bit of upside. Yeah.
Hi, so we have a question about, is this a good time to enter UE since it has come down quite a fair bit? Okay, so previously we gave a non-weighted presentation on UE. I believe that the sum of parts, the RNAV is roughly around $2.86, and that's actually excluding a lot of positives such as development fees that's come in. There's actually completed the Viva Industrial Trust, so it's already recognized the gains, and then it's probably going to recognize they can recognize up to $130 million of rental support income when the rental support is unwinded. So the question is this a good time to enter UE since it's come down quite a fair bit? We don't really have an opinion on it, but we think that it's trading substantially below the RNAV. Yeah, you can actually refer to the presentation slides for more details.
There's a question on Busted current trading price. At the moment, it's all-time high. Is it too bullish to enter right now? Once again, we'd like to reiterate that we think that it's still undervalued. This is based on first, its net cash position of 225 million, right, versus its current market cap of 783. And also, we continue to see the positives. Should it be able to positives from the industrial portfolio being able to read in the future. Also, we continue to see good recurring income. Recurring income will come from two areas once again. The first area would be from the industrial property design, build, and lease. And second one would be the geospatial technology. On the geospatial technology, it's actually a pretty sticky source of revenue. The people who use the technology are actually the government. So the growth areas for geospatial technology are Australia, Malaysia, Indonesia. Right, so we still see a lot of growth for the geospatial technology, and this revenue once again is recurring and relatively sticky. So based on these points, we continue to be bullish on Busted, and we believe that there is still upside potential with a target price once again at $2.05.
Hi, there is a question on regard on what are some of the stocks that'll be good in the long-term horizon of 5 years. Okay, for this, I would recommend the telco stocks, as telcos are basically in the evergreen stocks, and they are some of the most stable company offering good dividend yields of about around 4.5% currently. And right now, there is also growth in the telco stocks, mainly due to data monetizing, which will drive up the mobile revenue. Okay, market view. What is the market view of Singapore market in the month of December? Essentially, as long as the support line that I mentioned is not taken out, we think that it's actually bullish. There are more reasons to go up than to go down. To answer your question. Okay, what would be the catalyst for the Singapore market uptrend? I mean, there's a few reasons. I mean, first, Singapore market is correlated to the US market. Okay, the US. So the global catalyst would be Janet Yellen's dovish stance that has removed a lot of uncertainty from the market. She's more dovish than expected. That's one. Second, China is attempting to make a big reversal based on the economic reforms that they're proposing to do. We've seen symptoms that they could uptrend could be coming
because of the US market ETF gapped up last Friday based on this news. So based on US and China, there are more reasons for the STI to go up than actually to go down. So, but technically speaking, it's still on an uptrend, and as long as the price can remain above the support line which I mentioned, then we can assume the uptrend is still going on.
Hi, thanks everyone for tuning in. With this, we shall end the webinar. Look forward to you joining in again, same time next week. Thank you.
I'm not too sure about it. Oh, sorry.